Hey guys, I want to talk to you about compound capital growth, the power of compound capital growth in the investment property market. When you buy one property, you're hoping it's going to go up in value, because the rent just makes the interest payments for you. Your rent and your taxes covers that. And the way you make money is when the property actually just goes up in value over time. So I've selected a 10-year time period here, and we're going to map how properties go up in value. And I want you to see the power of compounding capital growth, not of just buying one property. It's when you buy more than one property, you have two or three properties going up every year all the time. This strategy I'm talking about now is just an academic. We're going to buy 10 properties. We're going to buy one property every year and just see what happens. So year one, we're going to pay $400,000 for property. Investment properties, you want to have low prices so the interest matches the rental payments. And I'm assuming here a capital growth rate of 7%. That is the actual for Australia, just for average properties across the board. That is the historical growth rate. You can pick properties that are going to grow up faster, go up in value faster than that. Sydney's gone up in value 20% for the past 2 years running. But I'm going to play it on the historical average because Sydney might go down a bit and it averages it out. And we know properties just don't go up the same rate every year. But this is just the exercise. Property markets, they go up and then they level off, then they go up and they sort of level off. That's the way it is. But this is the way we'll look at it. The numbers after the 10 years come out to be the same, but I just want to look at it this way. So year one, we paid $400,000, 7% growth, 428, 457, and after 10 years, it's worth 735,000, and we've made 335,000 in capital growth. Now, year two, we're going to go buy a very similar property, and since it's a year later, we're going to just say it's worth 425,000. Same scenario, going across, we're making this money. So the next year, we're going to buy one for 450. And next year, we'll buy one for 480. So we're starting to generate a larger total investment and more capital growth. Remember, most of this investment is debt at the moment, at the very beginning. But then as capital growth happens, we start making more growth. We've made, after 4 properties, holding them, the first one for 10 years and then 9,876 years, we've already made 1.1 million. And we can keep playing the scenario out. 513 will be the next price. Keep playing this scenario out for 10 years until we get to our magic number that we want to make. So we'll go to 548. Just bought another property that year. So easy to do it when you do it academically. But okay, let's just say we've done that over 6 years. So we've made after 10 years from our first purchase, we've made 1.5 million, and we have 404.3 million in debt. But we've had that much capital growth in equity. That's just how the compounding of the growth takes you. This is how people get wealthy in Australia. Most people in Australia get wealthy through real estate. And it's through capital growth over time. And residential real estate is a very safe and effective way of doing it. A lot of people hesitate and they overanalyze. We call it analysis paralysis, or they just don't take the time to do the work to understand what they're doing and educate themselves in property and in the borrowing money about how to find a good location, about how to listen to your property coach and mentors listen to your mortgage brokers and your bankers and build this team around you to where you're getting the right information so you can make good decisions. And they're not putting the work in to build that team. So they're hesitating and they're holding off and not doing it. And I want to show you something here. It's for that you hesitators. They're going to hold off. We're going to just pretend that you are going to hesitate and you're going to overanalyze and you're going to be scared and you're just not going to act for the year. And you're not going to buy this first property. It's just not going to happen. We got 1.5 million profit right now, but we're not buying the first property. It just cost us $300,000 for not buying that first property. We bought it, 1.5. Well, let's just say now we bought the first one and we waited a year and we didn't buy this one, the second one, and then we bought one and we waited another year. We weren't so aggressive. We still got $984,000. The big, we'll reverse that back out from 1.5 to $1 million. So you lose $500,000 by not buying those two properties. But if you take this one out, clear contents, you take out $300,000, but only $500,000 by missing those two. So what I'm trying to say is you don't have to go at this rampant pace that I went at, but you do have to buy this first one. That's the most important one, because these 10 years we go through, that's your life. That's your whole life. So your first one kicking it off, that's where you make the most money by acting and moving and taking action rather than sitting back and waiting and procrastinating. That's the main thing I wanted to point out to you. The power of compounding capital growth and the importance of starting now. Starting your journey to financial freedom now. This is your life, 10 years right in front of you. You need to get it kicked off now. That's where the most power happens. You don't have to do the whole 10 years. You still can make a lot of money, but if you don't start with this first one, you won't make any. And if you don't start now, you're going to lose the most. You're going to waste your life. That's what I wanted to go over. Thanks for listening.